For every 100 ounces of paper silver sitting on COMEX right now, only 13.4 ounces of real deliverable metal exist to back it. That is not a forecast. That is a CME published number. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Silver closed Friday at $81.18 on XAG USD. Intraday range $77.80 to $83.06. Verified by investing.com. A 5+ swing in a single session. That is not volatility for its own sake. That is a market under structural pressure. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, COMEX silver registered inventory. According to Blofin Research and CME Group warehouse data, registered silver, the only metal that can legally be delivered against a futures contract, stands at approximately 76 million ounces as of late March 2026. Against that, total COMEX silver futures open interest sits at approximately 576 million ounces. That produces a coverage ratio of 13.4%. Finance magnates published this figure directly. Exchange analysts at goldsilver.ai flag below 15% as stress territory. The last time coverage ratios were this compressed, silver repriced violently within weeks, not months. The timing is what deserves scrutiny, not the number alone. The timing. The May 2026 contract has 48,370 contracts still open, representing 241.8 million ounces, with first notice day fewer than 9 business days away, per goldsilver.ai. Think about what that sequence actually means. 241 million ounces of paper obligation, 76 million ounces of real metal. First notice day in under 2 weeks. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. In 2022, COMEX registered silver was above 300 million ounces, per historical CME warehouse data published by Investor Ideas. Today it stands at 76 million ounces. That is a 67% decline from the April 2020 peak. And it did not happen overnight. It happened across 6 consecutive years of structural supply deficit, one drain at a time. The data is already telling you something. Let's build it out. Now let's build the full picture, because the coverage ratio does not exist in isolation. The Silver Institute, the industry's primary research body, projects a 6th consecutive annual supply deficit for 2026, per reporting from Bloomberg and LogosPress.md. The projected shortfall is 46.3 million troy ounces, approximately 15% larger than the 2025 deficit. The primary driver is a projected 18% surge in bar and coin investment demand. Since 2021, per Trading Economics citing the Silver Institute and Metals Focus, an estimated 762 million troy ounces have been drawn from above-ground global silver stocks. To contextualize that number, 762 million ounces is approximately 1 full year of global silver mine output, consumed from the buffer over 5 years. The rate of depletion is not slowing, it is compounding. At the same time, the Shanghai Gold Exchange is pricing physical silver at approximately $82 to $83 per ounce in USD equivalent terms, according to goldsilver.ai and metalcharts.org, tracking SGE benchmark data. That is a 150 to 250 per ounce premium above COMEX spot. SD Bullion has reported SGE silver trading above $82, with premiums reflecting real tightness, specifically in 1,000-ounce bars being withdrawn from Western vaults toward Eastern delivery demand. The data is doing the talking. The ones who have been called alarmists for flagging registered inventory depletion, they are not saying much right now. And here is what makes that picture even harder to ignore. COMEX registered inventory is draining at approximately 22 to 23 million ounces per month, per Investor Ideas citing CME data from March 2026. At that pace, The current 76 million ounce registered stock represents roughly 3 months of burn capacity before the system is forced into emergency eligible to registered conversions at scale. Eligible silver totals approximately 400 to 470 million ounces across COMEX-approved warehouses. It meets exchange purity standards, but cannot be delivered until converted. Conversion takes 24 to 48 hours per CME Group procedure. It is a buffer, not a guarantee. At the same time, the Shanghai Gold Exchange premium is persistent across multiple months and multiple price levels. A temporary arbitrage premium normalizes within days. A persistent one signals structural tightness that arbitrage alone cannot resolve. That is not a contradiction. That is the setup. And before anyone takes that as a green light to size in immediately, setups can take a long time to resolve. The structural picture and the timing are completely separate questions. Anyone who claims to know the timing is selling something. Now, geopolitics, because this is no longer a backdrop, it is the primary variable. Here is the number most people are not talking about. One strait. The Strait of Hormuz. Approximately 21 million barrels of oil per day transiting through a single choke point, per the U.S. Energy Information Administration. Right now, that strait is under a dual blockade, with a 10-day ceasefire in place as of Friday, April 17th, per Trading Economics and Reuters. U.S. President Trump has stated publicly, per investing.com, that the U.S. naval blockade will remain in full force until a comprehensive agreement is reached. Iran's foreign minister has confirmed that vessels must transit through a coordinated route. Oil prices crashed more than 10% on Friday on ceasefire optimism, but the strait has not reopened fully. The IMF executive director, per Trading Economics reporting, cautioned that restoring a meaningful portion of disrupted oil and gas output could take up to 2 years even after a deal is reached. Markets are still pricing a clean resolution. Look at where oil ended Friday, down 10% in a single session. And tell me what probability you put on a clean deal holding across a 48-hour weekend with no live market pricing. When markets start pricing the reality of a partial or failed resolution, gold reprices higher, silver reprices higher, the dollar reprices as a safe haven inflow. That is the historical pattern. Every time a fragile ceasefire has unraveled under active blockade conditions, it has not been different yet. Silver Western spot at 81.18 per investing.com. Shanghai SGE equivalent approximately $82 to $83 per metalcharts.org and goldsilver.ai. A 150 to 250 premium in the physical market. The short-term picture is this. Today is Sunday, April 19th. There is no live market pricing until Asian futures open Monday, April 20th. The DXY sits at 98.10 per investing.com at multi-week lows. The 10-year Treasury yield is approximately 4.25% per trading view, having declined 0.86% over the prior week. Both readings favor silver in the immediate term. If the DXY holds below 98 and the ceasefire holds, silver has a clear technical path to retest $83 to $85 at the Monday open. If any weekend diplomatic development breaks negatively, Iranian officials rejecting terms, a Strait incident, a U.S. escalation signal, silver gaps lower and retests $74 to $76 before the structural bid reasserts. That is the only short-term read that matters right now. As for trading the Monday open, I cannot see a clean picture on the lower time frames. I cannot tell you what silver does at 9 p.m. Sunday when Tokyo opens. Nobody can. If you think you know, good for you. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. CME Group raised initial margin requirements on silver futures in February 2026, triggering a leveraged long liquidation that sent silver from $88 to $71 in days per investing cube. The DXY rebounding above 100 compresses silver prices at a 1.5x beta relative to gold, per historical data cited by Crux Investor. March CPI came in at 3.3% annualized per trading economics, the highest since May 2024, keeping the Fed on hold with zero probability of an April cut per CME FedWatch. The bull case is equally real. COMEX registered silver coverage ratio at 13.4% is the lowest in modern exchange history per Blowfin Research. The Silver Institute projects a sixth consecutive supply deficit of 46.3 million troy ounces in 2026 per Bloomberg. SGE is paying a persistent 150 to 250 physical premium above COMEX spot per goldsilver.ai and metalcharts.org, a signal that physical tightness exceeds what paper prices currently reflect. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. The structural pressure is already built into the system. The registered inventory drain is documented. The sixth consecutive deficit is projected. The SGE premium is live. The only question is when the paper market catches up to what the physical market already knows. Don't take my word for it. Verify every number I gave you today. Check CME Group official warehouse data at cmegroup.com. Check the Silver Institute World Silver Survey at silverinstitute.org. Check SGE benchmark pricing at en.sge.com.cn. Logic over hype. Always. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. OG John AG 1.0, out.